live. The following Crypto Academy video is designed to give you an overview of quarter level theory and help you understand how to apply that in cryptocurrency. Trading can contain substantial risk and is not suited for every investor. By watching this training, you accept the full terms of this disclaimer and responsibility for any of your own investment decisions. This lesson will focus on answering the following questions. Before we continue, pause the video, read through them, and be certain to minimize any distractions. Quarter level theory speculates that daily fluctuations in the market are not random because price can move between levels of structure based upon major whole numbers and experience significant reactions after arriving at these areas of support and resistance. There's a lot of human emotion that's going to be in play when we're looking at quarter level theory, and this is defined as a constant 250 pip interval that makes up a larger 1000 pip range. So we can apply this theory in any financial market and use these levels as targets for potential trade ideas while understanding the power in patterns in price action that we can expect to see occur at these levels. If we were to apply quarter level theory to Forex, using the Euro USD on the macro, 1.2 would be considered a major quarter. 1.225, a quarter level, 1.25, a half quarter, another 250 pips to the upside would be another quarter level, and then 1.3 would be the major quarter to complete that 1000 pip range. If we were looking at something like USD JPY on the macro, 100 would be the major quarter level. 105 would be the half quarter, and 110 would be the other major quarter level. We can also apply this on the intraday action. When we look at this in 100 pip ranges on more of a micro scale, 100 could be the whole level, 100.25 would be the quarter level, 100.5 as the half level, 100.75 as the quarter, and 101 as that next whole level to complete that 100 pip range using 25 pip quarter levels. When we think about cryptocurrency, it's the exact same theory. Bitcoin, its major quarter of 7,000. If we look 250 pips to the upside, 7250 is that next quarter level. 7,500 as the half quarter, 7,750, followed by 8,000 to complete that 1000 pip interval. And you can see those 250 pip ranges, not just in Bitcoin, but in Ethereum and other cryptocurrencies as well. If we wanted to apply that same concept of looking at this in a micro perspective, 100 pip ranges, we would have 7,000 as the whole level, 7,100 as that next whole level, and then 25 pip intervals to effectively separate the market into levels. When we're looking at something like Bitcoin, and we're actually applying the theory, we can take our horizontal lines, and so we're going to start by placing one directly at 7,000. We're then going to create another one, and we're going to place it at 7,250. We're going to do the same thing at 7,500. We're going to do the same thing at 7,750. And we're going to do one more at 8,000. Now we have 5 price levels on our screen, and we are on the daily time frame. So regardless of what time frame you're looking at, you're going to be able to see significant reactions more often than not occur around these quarter levels, and this isn't just true for cryptocurrency. Although we can see when we look at something like the quarter level at 9,000. If we want to put on that price level and backtest, we can see some pretty significant reactions. What about 10,000? The the same thing. So now this theory, when we apply it in the Forex market, and we start looking at the market in levels. Let's go ahead and let's put on a price level at 1.2. Already we can see some pretty significant movements away from that area. What happens if we were to come and put on a level at 115, the half quarter of that 1,000 pip range? We can see that this entire movement, this 500 pip movement that occurred over a few days, halted within a few pips of that half level. And now we're seeing a nice retracement. And where do we come to? If we look at the high of these candles, right in alignment with that quarter level. So it's pretty fascinating when you think about the market in terms of levels. And the structure itself, you're going to be able to find clues regardless of what time frame you use if you start to apply the simplicity of looking at the price scale and understanding the power behind individual price levels. When you're backtesting, be aware of what happens at those particular price points. And I promise you that the more that you apply this theory onto your charts and the more that you start to notice what happens at these quarter levels too, it's going to drastically improve the way that you look at the market, and it's going to increase your confidence when you're getting specific confirmations occurring at a quarter level because now you're understanding more about the cycles of the market. In summary, quarter level theory is a powerful concept that can help you understand more about daily price fluctuations and notice patterns that occur at areas of supply and demand, also known as support and resistance. Apply the levels on your chart and backtest to increase the efficiency of your practice and find yourself feeling even more confident once you get that confirmation occurring at a specific level in the market. Be sure to leverage the resources made available to you, and the most important thing is to stay plugged in. As you implement the information, ask questions and remain open minded, because all trading requires is persistence, discipline, and acceptance that you can and will learn this skill set.